there when the stock market breaks historically. That's when the data points shift. So today we got some good data points, right? Okay. You usually don't get an ongoing negative pattern in the data points until the stock market tops. You don't get them ahead of the stock market break. You get them afterwards. And what would that do to the central banks? We know what it would do. Pedal to the floor. Monetary policy would ease, money supply would grow, rates would drop. And that helps fuel gold.
Gold prices surged above the historic threshold of $2,700 per ounce on Friday, driven by escalating tensions in the Middle East, uncertainties surrounding the upcoming U.S. elections, and relaxed monetary policy expectations. This significant movement in the gold market has pushed the metal into uncharted territory. In August, gold and U.S. equities exhibited their closest correlation since November 2005, with a remarkable positive coefficient of 0.927, indicating a synchronized movement between the asset classes. MichaelOliver, a renowned market analyst and founder of Momentum Structural Analysis, emphasizes the historical relationship between stock market performance and gold prices. He notes that when stock markets decline, economic data often shifts negatively, leading central banks to ease monetary policy by increasing the money supply and lowering interest rates. This response typically benefits gold, which maintains its status as a safe haven asset during periods of financial stress. In September 2024, while gold prices slipped, U.S. stock markets rose on Friday, buoyed by softer-than-expected inflation data and strong GDP figures. This dynamic resulted in the most extreme correlation between gold and U.S. equities in nearly 2 decades, with both asset classes finishing August at record month-end highs. Historically, Michael observes that gold rises when the stock market declines. This pattern was evident during previous bear markets, such as from 2000 to 2002 and 2007 to 2009, when gold prices climbed while stocks struggled. For instance, the cost of gold rose from around $700 per ounce in late 2007 to over $1,000 per ounce by early 2009, continuing its ascent to nearly $1,900 per ounce by 2011. As these economic indicators unfold, investors may reevaluate their strategies in light of gold's historical resilience and current performance amidst market volatility. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If you go back to, I think it was March of 2023, we actually had a bank crash, meaning there was a period there where the S&P had already made its low in 2022. And in March of 2023, the banks, and MSA called this, by the way, we could see there was vulnerability on momentum structures of the KBE. And this was in late January. Well, in early March, you triggered those technicals, and you actually had a 30 to 35% drop in banks in a matter of a month. That's of crash dimensions. The overall market suffered a little bit. The banks suffered a lot, very dramatically. And of course, that woke people up. There were the stories about the mid-tier banks and so forth and so on. So in answer to the question, as an example, the banks actually had a crash and gold shot up strongly during that same period. I see the overall market going down, benefiting gold. This has historically been the case in other prior major bear markets in the last 20 years. 2000, 2002, gold went up, stocks went down, and gold kept going. 2007 to 2009 and on through 2011, gold went up. Well, the stock market went down to 2009 and took it several years to even get back to its high. So I see the stock market break is fueling the gold market, and especially the miners, as portfolio managers move money into that which is working. Whether they like it or not, whether they understand the reason for doing it, they're looking around at sectors that are doing well. And if the miners are doing well and the miners are cheap, and so-and-so bought them 6 months ago and he's doing quite well, maybe I need to join in. And it's a very small sector, miners, gold miners, and silver miners. So, if money flows in, it's a wet bar of soap being grabbed. There, when the stock market breaks, historically, that's when the data points shift. So today we got some good data points, right? Okay. You usually don't get an ongoing negative pattern in the data points until the stock market tops. You don't get them ahead of the stock market break. You get them afterwards. And what would that do to the central banks? We know what it would do. Pedal to the floor. monetary policy would ease, money supply would grow, rates would drop. And that helps fuel gold.
Silver traders are closely monitoring gold's price action, as the two precious metals often correlate. Gold's ability to sustain its gains could allow silver to break out of its current trading range. This relationship is critical for traders looking to capitalize on potential silver rallies. MichaelOliver emphasizes that silver is likely to follow suit as long as gold remains steady and firm. He advises traders to ignore the short-term fluctuations that can occur hour by hour, noting that when gold performs well, silver typically gains traction as well. While gold has been making headlines with its record-breaking performance, silver has been consolidating below crucial resistance levels. The $32.96 mark is a barrier and a potential springboard for silver prices. A breakthrough at this level could accelerate silver's upward movement, potentially mimicking gold's recent success. As silver traders watch these developments closely, the interplay between gold and silver remains a focal point, highlighting the importance of understanding market dynamics and correlations in precious metals trading. Let's get back to the interview.
Silver continues to act like that little wild dog on a leash. Sometimes it outperforms gold, and there's other times where it's, you think, oh gosh, it's never going up. Okay. But watch the mama market. As long as gold is steady, firm, ongoing, silver will follow it. Okay. There's no issue about that. You're not going to have an up in gold and down in silver. The short-term swings you see day to day, or maybe even hour to hour, they're to be ignored. So they outpace gold sometimes. So I think we're at the edge right now in this advance in the monetary metals, where if you engage anymore, you're going to really start to see more speed in both markets. And at that point, I think you'll see silver rush to the front again. The dog on the leash pulling mama this time instead of being pulled. And I think right now the thing to watch, and what we do at MSA, is we look at all four major asset categories. Foreign exchange has been dull for a year and a half. It hasn't played a role really in moving markets. Okay, the dollar, euro, that kind of stuff. The bond market recently, starting in July, shifted up enough in price, drop in yield, to break through some metrics for us that indicate probably over the next quarter or two, it's going higher. Yields will go lower. Now, in the last 4 weeks, you've seen the opposite. You've seen T-bonds pull back, while what? The S&P has gone up. Okay? The Fed cut rates, the S&P's rallied for 4 weeks. This is exactly what happened, by the way, in 2007 at the top. Fed cut rates, market went up for 4 weeks and topped. Okay. The bonds have become inverse to the stock market now, despite the seeming illogic of that. In other words, if rates go down, that should be bullish for the stock market, right? The long end. But it was the case between 2000 and 2002. When the stock market went down, rates went down. Bond market price went up. Gold went up. 2007 to 2009, stock market went down big. Bonds went up and gold went up, except for one brief month in that period for gold. It was a down. So both gold and T-bonds have been firming relative to the stock market, but they've not really unleashed on the upside in a way that's, headline generating. And I think the reason for that is that the stock market, while it's dancing around up here, every other day, Dow or S&P makes new all-time high. You hear it on Fox Business or CNBC. And each time it does it, it's like a marginal new high by 5 more S&P points. And then they pull back for a couple of days and they go up and make another new high. And it's constant headline, new highs. Meanwhile, the NASDAQ 100 so far has not made new highs. It made its high in July, I think it was, and you're still below it. Now, maybe it'll make a new high, but it's toiling around. And the thing I think that's important here is the stock market's dynamics. While price looks super good, it just keeps sort of going up. But when you run long-term momentum studies of it, like we do, and look for structure, meaning something that it could break that indicates it's shifting to the downside, we're dancing on glass on these momentum structures. In other words, we're not breaking them yet, but we don't seem to get up and away from them. Like, it's weak. Momentum suggests it's weaker than you think it is. There's almost no time in the history of the stock market where there's been a sudden dramatic drop not necessarily a crash, but a dramatic drop that was warned by price. It's always warned by the momentum of the market breaking something if you know how to measure the momentum, structurally speaking.
As gold continues to rise, its influence on silver's performance becomes increasingly significant. Traders closely monitor gold's stability, which could provide the necessary momentum for silver to break through critical resistance levels. This correlation underscores the importance of staying attuned to market trends in precious metals trading, particularly in these volatile times. How do you see the relationship between gold and silver evolving in the current market landscape? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.